So what is our edge in trading options? What's the advantage of trading options? Maybe you're new to options, maybe you're thinking about starting to trade options, maybe you're used to trading stocks, futures, forex, and those things aren't quite working for you. And you see all these people trading options and making money trading options, and you're wondering how? How are these people making money trading options? What's the edge in trading options? That's our topic for the day. So let me switch over to my trading platform. Of course, I use TASTYTRADE as my trading platform here. And if I go to an options chain for any ticker, let me go to Apple. I don't currently have an Apple position, but if I go to the options chain, and there are essentially four basic options trades I could make. I could buy a call, or I could sell a call, or instead I could buy a put, or sell a put. Those are your four basic options trades. Now, if you're unsure exactly what those four trades are, as far as how those strategies work, the long call, long put, short put, I have done a video in the past called the four basic options trades. Go watch that video if you're brand new to options. But essentially, when you buy a call, you're betting that the stock goes up. Right, you have to pay a debit. In this case, I would have to pay $10.55 for this call. $10.55 times 100, because options contracts represent 100 shares. So times everything by 100 when you're dealing with all the metrics here. So I have to pay $1,055 for this call. So if Apple goes up, I profit, right? Well, yeah, but because I had to pay for the call $10.55, I had to pay $1,055 for the call. I actually need Apple to go up at least $10.55 just to break even, just to cover the cost of my call. And the same thing with long puts. If I wanted to bet on Apple going down, I could buy a put. I've got to pay, in this case, $6.30 for the put, meaning I don't need Apple just to go down. I need it to go down at least $6.30 just to cover the cost of me buying that put before I can start profiting. And this really gets us to our first edge in trading options, is instead of buying calls and buying puts, instead you're on the other side of the trade. For example, selling a call. Well, now instead of having to pay $10.55 for the long call, with the short call, I receive $10.55. I get $1,055 in premium, in credit, for selling this call to the person on the other side of the trade, the person that's long the call, right? I'm taking the flip side of the trade. And remember, the long call, he had to really have the stock move to cover the debit he paid on the trade. But now that I'm short the call, I received a credit. That means I actually have a cushion, right? I'm short the call. I want the stock to go down, but the stock doesn't necessarily have to go down. It could go up. If it goes up, I really don't lose money until it gets $10.55 above my call, because remember, I received a credit. I didn't pay a debit. I received a credit. So I've got some cushion being short the call, right? I've got some runway. The same thing with the put. If I'm short the put, I receive $6.35 credit. In this case, a short put is a bullish position, but if the stock goes below my put, I have $6.35 of cushion, of runway to the downside. So typically, when we're talking about edges, our edge and options, it's really about being short options rather than long options. That's always the better play, because you receive a credit for selling options rather than paying a debit. It also gives you a much higher probability of profit, a better win percentage, because you have that cushion where the person that's long the option, they have to recover the cost of their long options. You're always going to have a higher win percentage selling options rather than buying options. And typically you're not doing these right at the money like I just did. If I sell a put, I'm not going to be selling that at the money put. I'm going to go a little further out of the money, maybe somewhere around 20 deltas. In this case, I'd go 19 deltas. I'm only going to receive a $2.49 credit for the 19 delta put, so it's not as juicy a credit, but now I have a much higher win percentage. Now I win 83% of the time as far as the probability of profit. If I manage the trade at 50% max profit, which is what most options traders will do, they'll set a profit target of 50%. The P50 number here, the probability of making 50% of profit at some point in the life of this trade, is 91%. 91% of the time, I'm going to be able to close this for 50% of max profit, which is $2.49. So divide that in half. I'm going to make $125 on this trade 91% of the time. Now, 9% of the time, Am I going to not make 50%? Yes, but I may make a smaller amount. I may still profit, or I may lose, right? And I may lose tiny. It's really hard to say exactly, is this a profitable trade over the long run? And Apple, I imagine it would be, just because Apple is kind of like the market. It drives the market and it kind of drifts up. Certainly, if I was doing this in something like SPY or QQQ or a market ETF, a market index, something like that, this has extremely good positive expectancy, meaning the realized outcome of your trades typically are even better than the theoretical estimates. So that's the first big thing you need to know if you're going to start trading options, is it's almost always better to be selling options rather than buying options. Another huge advantage to options over stocks and futures, when you're trading stocks or you're trading futures, basically it's a 50-50 coin flip. You buy the stock or you short the stock, or in the futures, you buy or sell a futures contract, whether you want to be long or short. And it's basically like a 50-50 coin flip. If it goes up, you win. If it goes down, you lose. Your probability of profit's always about 50-50, right? It's 50-50. But with options, I don't have to settle for coin flip kind of trades. As a matter of fact, if you primarily sell options, which is what I do, most of my trades have a win percentage of at least 70 to 80%. And I would say the vast majority of trades I make are in that 70 to 80% win percentage kind of range, like that short put I just sold, right? This 19 delta put has a 83% probability of profit, right? And if I go in a little bit, the 25 delta put, 78% probability of profit. Really high win rates on these things. And that's the great thing with options. I can pick my win rate, whatever win rate I'm comfortable with. If I want to sell the 11 delta put and have a win rate of 92%. I can do that, right? So this is something you can't do with stocks. This is something you can't do with futures. This is something you can't do with Forex. One of the things with trading is it becomes very difficult as a trader to deal with losing trades. It's mentally draining, and it's what tends to break traders down, make them quit, make them just give up the whole idea of trading. The great thing with options, if I know mentally I can only handle taking 5 to 10% of my trades as a loss, just because I hate losing so many trades, I can just ensure that any trade I take, for example this strangle where I sell both a out of the money put and an out of the money call, this strangle here has a 74% chance of winning, just because that's what I want on that trade. I'm comfortable with that win percentage. I want to win 3 times out of every 4 times I do a strangle, right? That's in my mind, that's what I'm thinking. But if I manage at 50% max profit, again, having a profit target is very good. 50%, you can see 90%. We got a 90% win rate if I manage this thing at 50% max profit. So out of every 10 strangles, I should win 50%. 9 out of 10. Now, another real advantage with options is as long as you're on the right side of theta, you have an edge. So we've already talked about one of the option Greeks, delta. Delta is your probability basically of finishing in the money. It tells you it's a good approximation of your win rate on the trade. Another important option Greek is theta. Theta is the amount of money you win or lose as time passes each day. Now, here's the thing. You don't really necessarily need to maintain or calculate your theta numbers. Just know this. When you buy options, like when you buy a call, you are negative theta, meaning as the passage of time goes forward, you lose money due to that passage of time. Time decay punishes long options. It punishes long calls. It punishes long puts. Each day that passes, this option loses value, and that's not what you want if you're the buyer of the option. But here's the thing. If you sell a call or if you sell a put, the passage of time actually benefits you because the option loses value as each day passes, which is what you want if you're selling the call, right? You want this thing to go to zero eventually. And what's one thing we know about the passage of time? You can't stop it. It's going forward no matter what you or I do. So you want to be on the right side of this thing. And this is another reason why as options traders, we tend to want to sell more options than we buy, at least those of us trying to trade smartly, right? We want to be on the right side of that time decay. So we've already talked about a couple of edges, right? If you sell options, primarily selling options, especially out of the money options, you benefit from a really high win rate. You also benefit, being short the option, from time passing, right? Theta, that time decay. Each day that passes is good for your position. Now, a third Greek that we should talk about, we talked about delta and theta. We should talk about vega, which is volatility. Vega tells us how an option's price changes if implied volatility goes up or down by 1 percentage point. So with long options, say you're long a call or long a put, when volatility increases, the price of the option increases, which is a good thing if you're long the option. Now, if you're short the option, if you're short that call or short that put, a volatility increase hurts you. What you want is you want a volatility decrease. You want the implied volatility of this stock to go down. That will actually cause the option to lose value, which is what you want when you're short the option. And there is this little hack in options trading. And there is this thing that we know. We know that implied volatility for any underlying tends to be mean reverting, meaning there is an average area of implied volatility that IV likes to hang out at. So if you can sell options when implied volatility on that underlying is high, it will probably come down, which of course helps short options. Once again, this is why we love selling options rather than buying options, is because we can go find something that has a really nice IVR. For example, if I go into one of the TASTYTRADE watch lists here, they have a high IVR watch list, and let me go find something. How about Adobe? Has an IV rank of 90. That's extremely high because it has earnings coming up in just a couple of weeks, but you know, because I know this really high IV rank and this really high IVX index here, if I move my head, so the actual IV percentage here is 41%, because I know that is on the high end of its range, right? 90 IV rank means this is in like the top 10% of its IV ranges over the last 12 months. What is IV likely to do, right? Because it's at the very high end of its range, it's much more likely to contract. IV is going to come down, which is great if you can go sell options, especially not just one option, sell two. So instead of just selling a put or selling a call, sell both. You get twice the vega in this case. Instead of just making money on vega from one option, you get to make money from vega on two options. You get twice the vega. Also, here's the other thing. By selling both sides of the trade, you get twice the theta, because the passage of time helps your short put, also helps a short call. You get twice the theta. You get twice the vega in this case. Also, you're directionally neutral. In this case, with a strangle, I don't have to bet on the stock going up or down. It just needs to trade in a nice little range, a really wide range here that I'm going to win on. Probability of profit says 77% of the time. If I hold it to expiration, I'll win at least 1 penny. Probability of 50% max profit at some point over the life of the trade, which is the number I would be more interested in, is 92%. Very high win rate, right? And plus I get all of that theta with each day that passes. I get a lot of vega should volatility collapse, and you never know if it will, but there's a very good likelihood it will when you have something that has a really high IV rank. One other important advantage with options is the fact that I can actually sell both sides. I can actually put on a short put, which is a bullish play, and a short call, which is a bearish play, at the same time. You can't do this with stocks, and you can't do this with futures. You can't go both buy and sell the same stock, because you own the stock and then you want to go sell it, well, you're just closing your existing long shares, right? You can't be both, right? And you can't do that with options either. I couldn't buy and sell the same options contract, but because I have different strikes, different expirations, I can always be in both a bullish and a bearish trade at the same time, trading options. And this is great because when it comes to being directional, you know, if I want to be bullish on something, or if I want to be bearish on something, or if I want to be neutral on something, I can construct an option strategy to fit that assumption. You really don't have that flexibility if you're just trading stock, because most stocks too are hard to borrow. You can't really short a lot of stocks, plus there's high interest fees on it. With stocks, typically you just buy and you hope, right? Futures you can buy and sell. You can play both. You can play either side, but you can't play them at the same time. And again, you're dealing with 50-50 shots, where with options, we have these really high probability plays. Also, trading options is much cheaper than trading stocks or futures. For example, remember, an options contract represents 100 shares of the underlying. So if I go and sell this 15 Delta put in Adobe, should I get assigned, I would have to buy 100 shares at $310 a share. But if I don't get assigned, right now this options contract, this short put, only cost me $3,100 in buying power to place that trade today. Now think about this. If I wanted to go buy 100 shares of Adobe instead, rather than playing it with options, what would 100 shares of Adobe cost me? Well, Adobe's trading at $362 a share. I would have to put up $36,000 to buy the shares. Now, most brokers are going to give you like a 50% discount on buying shares. So instead of $36,000, I would only have to put up $18,000 to buy 100 shares of Adobe. $18,000, or I could go sell a put for $3,100, right? You get some pretty good buying power relief. You get a little bit of leverage using options. And then finally, one of the biggest advantages for me with trading options rather than stocks or futures is the fact that I don't have to predict anything. I don't have to guess whether the stock's going to go up, down, sideways, because most of my options plays are really high probability trades that I don't care if the stock goes up, down, or just stay still, right? When I sell a out of the money put, it doesn't matter where the stock goes. It can go up, it's fine. If it stays still, that's fine. If it goes down, that's fine, as long as it doesn't go down way too much, right? I don't have to be right on direction. I don't have to guess right on direction. Same thing with the call side. Same thing if I put on both sides of the trade with a strangle. I don't have to guess right on direction. Because of that, I don't have to play that ridiculous and a stupid game that is technical analysis. I don't have to go draw random patterns on a chart. I don't have to scribble in my coloring book like I'm a 6-year-old, right? And say, oh, here's a support line, here's a resistance line, here's a bull bear flag thingy, right? But we don't have to do any of that because we all know all that's bullshit anyway. That has no predictive power at all anyway. And I don't have to pretend like I can do that. I have never been into technical analysis because I trade options, right? I don't have to deal with technical analysis at all. I also, as an options trader, I don't have to deal with fundamental analysis at all because most of my trades are short trades that typically only last 2, 3, maybe 4 weeks, most of the time. Fundamental analysis, if you're going to use it, is probably more appropriate for long-term passive investing where you're holding shares of stock for potentially years at a time. So with options trading, technical analysis, fundamental analysis, if you want to use them, you're certainly free to, but they're not going to do much for you. So my advice is, unless you just have all kinds of free time on your hands to bother with that stuff, just ignore it. So there you have it, just some of my thoughts on what are some of the advantages and what some of our edge is in trading options, and why we as options traders tend to do a lot better than those of you trying to make that day trading dream live, those of you trying to scalp futures and scalp Forex. That is an almost impossible task you're undertaking, where with some basic responsible option strategies, you can consistently make a little money with options trading right away. Like you can get up to speed and become a long-term, successful, profitable trader using options as long as you do it in the right way. Now, if you want to learn more about options trading, check out my book, The Super Wheel Option Strategy. This book is available on Amazon. You'll find a link to the book in the description below. Peace, guys.